Okay, welcome back everyone to RWA Week. I'm your usual host, Public Speak Strategic Advisor at RWA Week, and your host for today's live interview. We are going to explore one of the most important questions facing the next phase of Web3, as always. How do we move from tokenization as a narrative to real infrastructure for global finance? And I'm joined by someone with a particularly interesting perspective on that transition. We have Alice Lee, partner at Foresight Ventures and head of RWA at Bitget. Alice brings together a deep experience in consumer technology, venture investing, centralized exchange ecosystems, and rapidly evolving world of real-world assets. So we will talk about why RWAs could become a digital collateral layer for the global economy and what still needs to change before institutional capital can truly move on chain at scale. We will explore, maybe if we'll have some more time, AI agents, decentralized trust, differences between Eastern and Western Web3 ecosystems, and I have a lot of questions for you. So be prepared, be ready. Welcome to RWA Week. Let's dive in. Maybe you can share a little bit of a background of yourself. Present to me, like, for the first time, who are you, how you end up in Web3, and why you're building what you're building right now. What is your personal journey?
Sure. Thanks for having me, Polly, tonight. I'm really happy to join this interview. So I'm Alice from Foresight Ventures. I am the managing partner at Foresight. At the same time, I'm also leading the RWA arm for a global exchange called Bitget. Bitget is currently the top four crypto exchange in this industry, and I joined the company since 2021. I've been with Bitget for almost 4 years, and started from my career actually not started from crypto, right? I started my career path from the internet companies, starting from Amazon, TikTok. I was the product manager there, and later on, I joined a venture capital called Gauchon Capital, which was investing in SaaS companies. And then later, my interest actually shift from the traditional SaaS investment into crypto investment. That's when I started to look at the opportunities in that space when Bitcoin was at, I remember it was like a 10K to 15K at that time. And then at that time, Bitget is looking for someone to work for the family office, which turned out to be Foresight Ventures, and I was the number three hire in that team. And that was like a bold career decision, considering at that time, traditional VC seemed to be a more glamoring decision over like a crypto native users. At that time it was that not that mainstream, but I'm glad that I make the right decision to join basically a startup venture fund. And I watched Foresight and Bitget grow from essentially we only have like 300 employees. Right now Bitget has over 3,000 employees, so the company scaled 10x for the past 4 years. And we are definitely continuously delivering more innovations to our industry, and then more like better products to our users. Well, when it comes to the past experience, definitely we got a lot to share, especially when you go through the full bull and bear cycles, where you see a lot of the crypto VCs coming out. From last cycle, everyone was super excited about different token projects and about token launches. Now you see people start shifting from those narratives of meme to more towards stablecoin, towards RWA, towards AI, these areas that can actually bring real utility and real revenue. That has like the diagram has shifted drastically, and you also see a lot of the VCs has run out of money at this unfortunately, they invested it in too much of those meme tokens, and they don't really have the ability to raise next fund anymore. But for us, we are an evergreen fund that's supported by the family office, that multiple LPs. So luckily, we did invest in a lot of the AI and stablecoin projects before, so our return and reputations are still quite nice in this industry. And ever since last year, we started to look at something more interesting, which is the RWA sector. We compared different kind of projects in this space, including Ondu, X stocks. And at that time, I believe since last year, there were not many choices. Later on, we got Denaries, we got Securitize, etc. But we were the first ones to collaborate with Ondu, um, in the name of Bitget Exchange. And then later we decided that instead of being the largest partner for Ondu, why don't we build something interesting for Bitget? As in, we want to build a tokenization engine in-house for Bitget. That's why we came up with the idea of building the brand called Reality, which is a similar version but a better version of Ondu. And right now, Reality has performed really great. If you check our website, we only launched 2 months, and the TVL has grown to almost 200 million, and the trading volume ranges around 30 to 50 million per day. So it's one of the largest RWA protocol in this industry already. So we're really proud of like what Foresight team has done for the past few months. Yeah.
Well, that there is a lot to unpack, and thank you so much, Alice. It's a pretty interesting journey, and I love that you started in very traditional internet companies like Amazon and TikTok before making this big jump into Web3 and joining Bitget when Bitcoin was around 10 to 15K. For me, sounds like a dream, to be honest, because I joined Web3 space around 7 years ago, and still I think it was a little bit late already. Anyways, when you joined, there were like around 300 employees, and then watching the company grow to around 3,000 people is pretty incredible, right? And I think that also explains why your Web2 experience is so useful today, because you have seen firsthand how products and teams and distribution can scale pretty quickly. And I like the honesty in saying it was a bold decision. You highlighted it because in hindsight, every risky decision looks much smarter than it felt at the time. And what is also pretty exciting that you did not just stay on the exchange side, you moved into investing. So many VCs disappeared through the market cycles. A lot of my friends are just hiding right now from their LPs because they're afraid of what their decisions in terms of investing lead to. But anyways, I really appreciate how Foresight is at the front row seat in terms of good returns. You started looking seriously at RWAs, including projects like Ondo and Xtox, my good friends as well, and eventually helped build reality at Bitget's own RWA initiatives. A lot of things going on. I have no idea how you're keeping up with everything, but it feels like your journey is really a combination of consumer technology and investing, and now building the infrastructure for the next phase of on-chain finance. Incredible, incredible. I have a lot more questions, to be honest. From your past experience, you mentioned that you spent years in consumer product growth roles at tech giants like Amazon and TikTok before moving into Web3 venture capital. Let's tackle this part of your experience firstly. How did your journey and experience scaling user retention and distribution in big tech influence how you evaluate early stage Web3 startups and tokenomics models at Foresight?
I think it relates because like when you came out from the so-called big tech companies, especially you got the sense of like how systematic they could be, and how they could basically build like a different user model for retention, for user acquisition. And then I'm not saying all of those model works out, but at least they've got a so-called theory or like a mechanism to measure the success and measure the ROIs that they spent for each campaigns, etc. These knowledge are very valuable for early stage startup, especially in a new industry like crypto. You don't have any more benchmark. So I would say, like, when it comes to when we evaluate these projects, I did use a lot of those, helpful metrics to track the success of each project. Most importantly, like B2B project, it would be ARR, for the customer, like customer and user apps. You look at the 7-day, 30-day retention, etc. And I think more than just metrics, it's more about like people, about like when you talk to the founder, do they have this kind of like idea in mind that they should build this metrics and this systematic workflow inside of their company to make sure that everything is under their control. I think having those work experience definitely helped me a lot in sorting out the best and most solid teams for Web3 investment. But I would say it's still not a a standardized stuff, because crypto, um, a lot of things are driven by trends, like by meme, by narratives. So sometimes this model doesn't really work that well. Sometimes in KOL retweet might work better than all of those models.
Sorry, I was on mute. I it's funny actually because you're completely right in terms of QL retweets. Thank God in this cycle QL's not working that well anymore, and we're going back. I think more to standard Web2 procedures in terms of evaluating what kind of a project will live throughout the next 5 or 10 years. But I really like that point because in Web2, you learn very quickly that growth is not just about having a good idea. There is a whole system behind it. You can measure retention, user behavior, distribution, and see very clearly where people are dropping off. And I think that that experience is really valuable in early stage venture, even in Web3, because even when there are not many numbers yet, you know what kind of signals. I think it's even a feeling for a very experienced person you should be looking for. And I also agree that the consumer applications, especially very early ones, the founder can sometimes matter more than the spreadsheet and the team itself. You want to see someone who really understands the problem and has a very strong idea and can control the important parts of the business instead of just hoping the market will do the work for them. In Web3, where the numbers can sometimes look a little too beautiful because of incentives or token rewards, that discipline's even more important. So I think that your Web2 experience gives you a very, very useful combination. You can look at the data, but you also know when you need to look beyond the data and judge people building the company, if I can say it like that. But also, if we're going to the Bitget part, because I think it's also a pretty interesting part of your journey, this dynamic role of centralized exchanges, with Bitget expanding beyond standard spot and derivatives trading into incubator funds, ecosystem grants, and RWA integration, which is more important. The traditional exchange mandate, I would say, is changing. How do you see the role of centralized exchanges evolving to become true ecosystem builders rather than simple liquidity venues? Because A lot of exchanges are dying. For example, if we can take a look at just for the past 3 months, most of the competitors of Bitget now not existing on the market anymore, saying Bitmart, etc.
Yeah, yeah. I totally agree with you, Polly. You mentioned a great point. And this is like as I mentioned before, the market is shifting, not just for the VC, but basically for everyone who still remains in this game. And for the crypto exchange, it used to be the cash cow, and it's still the cash cow. But we do see like the trading volume for crypto assets has been drastically decreasing for the past few months. Of course, right now the price is back, so volume is back, fortunately. Um, but it's a common cycle, I would say, for each of the bull and bear cycles you see, some will profit, some will grow stronger, and the smaller ones will eventually disappear, or even the big ones for like FTX. If you make a mistake, then you just go bankrupt, right? Um, so I would say it's evolving, and the key to always stay in this game is firstly your scale. You have to reach certain scale to be, influential and build this brand awareness inside of your users, because this market, I would say, it's pretty matured already. Like the exchange business, centralized exchange, is pretty matured. And if you see from a product cycle perspective, I would say it's at maturity stage. So there won't be that much opportunity for smaller companies or like even startups, because you're already facing Binance, OKX, Bybit, Bitget, right? How are you going to compete with them? It's just like you have a Tencent, you have an Amazon in your industry. So the best idea is definitely to get a buyout. And right now we see crypto industry getting more and more regulated. All of those centralized exchange all wants to be, to get licensed globally. That requires a lot of money. So that's a huge hurdle for all of the small startups. That's why most of them cannot make it. They're selling their assets to the big ones. And fortunately, Bitget has grown from small companies to bigger ones. For the past 4 years, we're growing much faster than a competitor, due to the reason that firstly we care about our user the most. We Last time, a few weeks ago, there is a um, glitch in our system, and then we decided to refund all of the cost and loss for our users. It was about 40 million. So that really shows like we do have a strong risk management capability, and secondly, we do care about our user more than our assets. it, I would say user is our assets, and that's why, like, that's what carries Bitget to go this far. And we will continuously to build on top of that thesis. And another thing is, I think for rest of the exchanges that still remains in this game, right? Um, we see most of them will start shifting from merely just a crypto exchange to a universal exchange that could trade everything. Um, if you look at Coinbase, right, they're trying to um, be a universal exchange. If you look at Robinhood, they're trying to bring on more crypto volume. If you talk to other financial institutions, right, they're trying to bring on more crypto users. I think everything is just merging, and you can't just be the single liquidity venue. In order to stay in the game, everyone needs to provide users with a full stack of services, basically not just crypto assets, but also traditional assets, stocks, commodity, silver, gold, and everything. Yeah.
Completely agree with you in terms of everything is merging right now. We're not anymore in Web 2 and not anymore in Web 3. Someone is saying that we're already in Web 4, but we're not touching yet AI, agentic economy. Um, we are somewhere in the middle where there is no more crypto. Crypto is just financial world on better infrastructure rails, and very lot of important points that you mentioned, Alice, because the exchange business itself has become much more mature and much more competitive as well. As you said, trading volume can fall very quickly when the market moves from a bull cycle into bear cycle, or somewhere in the middle of bull and bear, and like stagnation is also very annoying. So relying only on trading fees is pretty dangerous game. And I also like your point about scale, because it is very difficult for small exchanges, small startups, to compete with giants like Binance or OKX, so on liquidity, brand, technology, and specifically licenses, because regulatory landscape is maturing as well. And what really stood out to me was the example of this 4 million you said, right? In terms of refunded fees on the glitch, or please correct me if I'm wrong.
Yeah, we actually refunded the user over 40 million.
For 40 million, okay, yeah,
Yes.
40 million. I think that that shows something very simple. In this business, trust is an asset, and sometimes keeping that trust is more important than protecting short-term revenue. So heads off to this appropriate risk management, I would say. We're also, I think, seeing the bigger shift with companies like Coinbase and Robinhood, as you mentioned, where the exchange is becoming more like universal financial platform with many different types of assets. So I think the future tax centralized exchange is not just a place where you can come and trade Bitcoin, but it becomes a place where you can access stocks, crypto, RWAs, other financial products in one ecosystem, and specifically earn yield on it. And honestly, that makes the competition even harder, because you have to be very creative and maybe think in advance. Okay, what these big guys are trying to offer their users that we can do faster than them. So it's pretty interesting game, and the opportunity is much bigger for platforms that can really put users first here, I think. But anyways, on another note, I would love to dive deeper into your personal vision and thesis, specifically for real world assets. You have made the case that the future of global finance isn't just about digital money, but about around $30 trillion digital collateral layer powered by tokenized treasuries and real world assets. How do you think, what is the single biggest technical or maybe market friction preventing traditional financial allocators from deploying their balance sheets into on chain collateral pools today?
I think you asked a really good question. This is something that we've been, asking ourselves a lot. Because if, as a saying, like if Bitget can be the venue that brings all of those traditional money on chain, we could grow 10x than that. So it's definitely a great question that worth like 100 million. Um, and I think the reason why, simple answer is we're still early. Um, but if you break down that into like a different user funnel, then you will see a lot of blocking points on the way when traditional financial institutions wants to move their money on chain. So the first thing is on off ramps. How are they going to move money um, to a wallet, right? Um, and how seamless that experience can be. If I found my wallet and I will still be charged at a very high fee, then how am I going to make that money back? That's for one. And usually, when you move that huge amount of assets as an institution, then you probably will be checked by the local banks and regulators, which I would believe a lot of them, a lot of the traditional financial companies don't really want to go through those procedures. And that's only the case when you're in the US, and also if you're in China, in Hong Kong, in Asian countries, that will trigger a lot more questions from, regulators. So that's one. How are we going to solve the on-off ramps? We're seeing already a lot of the companies that are building in this space, including Bridge, BVNK, right? In Asia, we've got OSL, which is also our portfolio company. They deliver the on-off ramp solutions for institutions, and they're already one of the largest on-off ramp providers in Hong Kong. And there are still many things, many licenses that they still need to work on, a lot of the user friction points that they still need to work on. So that's for the first layer I would see as the bottleneck. And then the second part is you asked about the on-chain liquidity pools, right? When it comes to on-chain like DeFi protocols, there's always a layer of trust, as in, firstly, the financial institutions has to be comfortable depositing their money into those on-chain vaults. Even for Aave, they got hacked. Morpho, maybe a better decision because the votes are isolated, but how are you going to convince like someone as rigid as like a 60 years old company to use Morpho? It will be, there will be a certain gap, and then take some time for them to observe and learn the new things. And then the third thing I see is, when it comes to DeFi lending, borrowing, staking, you will always need liquidity 24/7, right? When it comes to, how are you going to liquidate your assets during the weekends? Who's going to market make? Who's going to provide those price feed? There are still a lot of the infrastructure that's not that mature. Say if a financial institution wants to tokenize their equities, wants to tokenize their bond, who's going to provide these infrastructures for them? I mean, BTC, ETH, I think the on-chain liquidity is enough, but for those traditional assets, even for us, we're building that for reality. I think there's still a lot of things to do, because market makers will come to you and ask like, what's the incentive for us to market make during weekends for those stocks? I'm not making any money because there's not enough demand. But if there's not much liquidity, then there won't be any user willing to trade during the weekends. So there's always like a chicken first or the egg first problem. And before and we're just talking about retails, right? Retails, if it's institutions, they will have a much less tolerance on these user experience and those friction points. And last thing is, even if you've got the infrastructure ready, so people always ask like where the yields are coming from, where the DeFi yields are coming from. If it's not as attractive as the traditional yield, tradition as the yield in traditional products, why would I put my money on chain? And right as of now, we don't see on-chain yield as that attractive anymore, because of course the market is going down, and then a lot of the rates has been going from, Ethena is from like over 14% to right now I think is ranges around 5% ish. So that's for crypto assets, right? I think for equities, for bonds, the yield on chain is even lower. It's just like we haven't found a really good use case for those DeFi lendings for the traditional assets. And all of these adds up to leads to the current situation where everyone thinks on-chain votes, on-chain collateralization might be a really attractive narrative for RWA assets. Yet a lot of the institutions, a lot of the whales are still, you know, think like watching the space. I don't think it's gonna grow drastically, but you see some um, companies that are already actively working on this. You look at the Gauntlet, they have a few pools together with I think that was with B stocks, which is Binance RW token, and Gauntlet also has launched something with Ondu. But for that one, for these pools, Ondu doesn't really give them much APR. Doesn't really like the rewards are not attractive, so nobody's using that. B stocks, yeah, they did give out some APRs. So there were like some trading use cases, but still the market is very small right now.
Mm-hmm, mm-hmm. Okay. Um, so thank you so much for such thorough breakdown, Alice. And I think that we're too early is actually one of the most honest answers in this market. Like, because sometimes crypto likes to pretend everything is ready for mass adoption tomorrow morning. But what you described shows that the problem is not one single piece of technology, and it is in the whole journey from moving money on chain to finding a trusted protocol and finally creating enough liquidity. And for traditional company, especially 60-year-old financial institution with board members who are like 88 years old, asking them to put money into DeFi world is not exactly the sales meeting. You probably need more than a nice speech deck and very confident hoodie, right? So the trust issue is pretty huge. This is what I can vouch for. I faced it personally as well while negotiating for some of my projects on advisory, and I don't know. Maybe the honest answer is just we need to wait for the new generation to take on the board members' seats. But it's a cruel answer. So
Yeah,
anyway,
that'll take us at least 50 years.
yeah, but maybe 25 years, maybe that's fine. But anyways, the trust is pretty huge, and because even when protocols become more secure, one just one major hack can make an institution step back very quickly. Then you have less glamorous but very important infrastructure, like market makers, price feeds, bridges, licenses, reliable on and off ramps. And I also really like your final point about demand, right? Because if the yield is not attractive and the user experience is difficult, why would someone move their money on chain in the first place? So yeah, it feels like RWA industry is building many important pieces today, but the real breakthrough will come when all those pieces finally work together and using on-chain finance becomes easier than staying off-chain. But yeah, I think we will be 50, 60 years old by then when infrastructure is ready. But yeah, we're early. So this is probably the answer. Anyways, being really early in AWS, let's be early as well in Web4 and autonomous AI agents. It's another point that I also wanted to touch. The industry is shifting rapidly from human-driven crypto trading toward autonomous AI agents executing financial transactions on chain. Slowly, we're going there, not with all permissions, not with a lot of tests, but we're going there. How do you think? How does decentralized infrastructure like smart contracts, zero knowledge proofs provide this? The necessary trust and settlement layer for machine to machine financial activity. Is this even viable? Is this something that you saw in practice already?
I think for the smart contract level, we see a lot of the use case already, like the X402 on Coinbase. So actually, a lot of the protocols are already using it. Um, but I think we're very early in this space as well. We like Bitget. We also explored some ways to allow our users to trade with AI within our own app. And then we found that, user um, like their behavior is quite interesting. They won't ask like, can you give me an analysis about the fundamentals? What they really care about is how are they going to open up more leverage in our platform? How are they going to make more money on meme? So I would say if you look at the user today, there will still be early adopters that are still trying to use AI to make more money in crypto. These are the early adopter, and then later we'll probably see the curve. AI come into everyone's life, and then the users that have um, more diverse trading requirements may come in. Maybe they wanted to trade risk adverse assets, right? Maybe they want to build a portfolio, maybe they want to trade ETFs in the future. So for that, we are working hard to provide them with a good, basically an investment agents where we could teach our user the basic knowledge about financial risk management, about portfolio management, about how to uh, basically just analyze the fundamentals of each of the tokens that you want to buy. So I think we could help the users to understand and use AI in a better way. But in terms of trading itself, we will still be pretty conservative in um, allowing AI to automatically trade for our user, because that is a black box. That is really hard to justify when an AI actually lose money. If it makes money, it's great for everyone, right? So if it loses money, somebody has to take the responsibility, and that person cannot be the AI, unless you allow it to, unless you just build the AI from scratch. So there's still like a very very fine line between AI trading and AI investment advisor. So right now, from the business side, we are more on the AI investment advisor. But for if you look at the VC perspective, I see some companies that's using AI for trading, basically in some simple scenarios such as B2B subscription, where they allow the agents to have a wallet, and then they could automatically sign up and renew the SaaS subscriptions for some companies. So it works more in terms of like a middleware. Also, sometimes you see these AI are helping those data companies to get more data endpoints to pay for better quality data, better data labeling services. So these are the areas that we see AIs are really getting to the trading aspects, where they have a wallet and then they can automatically place orders. Yeah. Um, but I would say when it comes to real trading, still people are conservative from having the users having the AI to actually make the investment decisions.
Yeah. And to be honest, I really like this cautious approach. It's it's the right approach in terms of all this AI trading, because it sounds amazing until you remember that AI can also lose your money with incredible efficiency. So we already seeing exchanges and protocols experiment with AI, and thank God they're just experimenting for now. But the big question is how much control users should actually give to a machine. I think your point about users being interested in quick profits is very real. Let's be honest, not a lot of people are trying to analyze whole fundamentals of each token that they are trading. They're trying to find 20x leverage on some memes. This is the usual behavior of, I think, every crypto exchange, and not even crypto, just exchange. Um, it's more likely, it's more interesting to find 20x leverage than reading 20-page token report, right? And at the same time, teaching users about portfolio management and fundamentals could be much bigger opportunity for the industry in long term. And I agree that fully automatic trading is still difficult step, I would say, because when the AI makes a bad decision, someone still needs to take responsibility for a loss, and that is why I find the middleware opportunity very interesting that you mentioned, where AI helps with things like wallets or research or trading tools or business subscriptions, without completely taking control of the money. So maybe the future is not AI replaces the trader, but AI becomes the very fast assistant sitting next to the trader, and hopefully one of that does not spend the whole portfolio on meme coins while everyone is asleep. So let's see. Let's observe what's going to happen next, and maybe some final questions that I will have for you for today, Alice, is about market structure and personal perspective on several things. I'm extremely interested in differentiators and differences between ecosystems in West and East. And as you're sitting at the intersection of Eastern tech hubs and Western institutional capital, I think you have a clear view of both landscapes. How do you think? What is the major strategic difference in how Asian Web3 founders build and scale compared to their Western counterparts? And where do you see these two worlds aligning most effectively?
Um, I think for the differences between Eastern and Western founders, um, in the Web3 space, you see uh, like Asian founders used have like a urge to be successful, and they have this idea of um have um I would say product operations wise, they do a little bit better than Western founders, because they see a lot of the internet companies, Tencent, TikTok. They're all basically, a lot of the Asian founders have worked in these companies, and then they are well aware of this user acquisition strategy, those operating strategies, um, and when it comes to deliverables and timeline wise, they could deliver well, um, because of this their way to manage the team. So they have a clear goal, they have a clear timetable, and when it comes to Western founders, I would say they're more strategic and innovative. So they most of them probably don't have that much background working in these companies, or even if they used to be like engineers in Amazon, in TikTok, sorry, um in these companies, they tend to be more, um I would say they have a bigger picture about what they want to build, and they wanted to actually change the narrative of today's crypto world. So there are two type of founders that I would say, but I think both of them are pretty nice, because as a team you need to have different opinions and different styles in order to you know be on the ground, as well as aim higher for like achieving better goals. So what we see, most successful teams have two co-founders or three, with a mix of both Eastern and Western founders. For example, one of the one of our how do I say, one of our broker partner is called Alpaca. So the founder is Japanese, two Japanese, one is CEO, one is CTO, but the revenue, the CRO and CMOs are from America. So I think the team worked very well in expanding the relationship in the US, for regulators, and also for like delivering great reputations, delivering great products in Asia. So that's a great example. But we also see bad examples of having different co-founders from different countries, but they don't worked very well. They don't understand each other. So it's a double-ended sword, double-edged sword to have a global team.
I still think, from my personal opinion, that it's better when there is a combination, because different views definitely helpful. But I think that both co-founders, they should have had uh, prior to being a C-suite in some company, a different experience. For example, if a Asian co-founder had a Western experience, they can understand better what is going on, and vice versa. So I really like that balance, because it sounds like the strongest teams are not choosing between East and West. They're kind of combining the best parts of both. And as you said, many Asian founders bring a very strong execution mindset, clear goals, clear timelines, and a lot of focus on the product and operations. And because many of them have worked in big US, maybe technology companies, they can take those lessons and move incredibly fast. And at the same time, Western founders can bring a more big picture, and sometimes maybe even be more disruptive, creative in the view, especially when they're trying to change how people think about Web3 or crypto or finance. So you get one saying, hey, here's a big idea, and the other saying, great, but we need to ship this by Friday. So this kind of a balance is a huge advantage, and it's a healthy combination, I think. And I also agree that different opinions are important, because if everyone in the founding team thinks exactly at the same way, you may have a very peaceful company, but not necessarily a great one. Not sure if it's rude, but yeah, probably this is true.
Yeah, yeah, I totally agree with that. But as long as it doesn't escalate to a point that your team cannot work together, until that point, I think all of those arguments and controversies inside a team is a healthy environment.
Yeah, agree. There should be always a healthy balance. And maybe the last question that I will have for you for today, Alice, just would love to understand better how you are navigating market volatility, um, with different principles. For example, venture capital in Web3, it often gets pulled toward short-term speculative hype cycles. We've been through there. From your perspective, leading investments at a 400 million fund, what core metrics or fundamental signals do you rely on to identify sustainable and long-term utility that survives volatile market conditions? And maybe what small piece of advice you can give to founders who are in raising stage right now?
When it comes to investment, right, one of the metrics that we look at is definitely PMF, product market fit. So, if you look at the companies, what they're doing, like close enough, maybe every company can just summarize their selling point into one sentence, and that could be your core value proposition, and we'll check if that is attractive for the audience, if the potential user is big enough, if you're going to deliver something that's so unique that they cannot live without you, then that means you're making it, you're working on the right direction. And if you're not looking, if you don't see that part, like super glamoring selling points, I think that means probably you're just selling a nice to have solution rather than a must have solution. Yeah. So one of the advice I would give to you, to founder is try to find this try to find the PMF as soon as possible. And there could be a lot of the decisions to make, and a lot of mistakes to make before you can actually find a PMF. So you gotta pivot fast. You gotta be open-minded and be willing to make mistakes, but always limits and limit the cost of trying different directions, and still, be positive and bring the team together to build the right vision. Yeah. And all the money, all the fundings and reputation will come along once you find the right direction, and keep working on it.
Totally agree. Thank you, Alice. And I really like that answer because must have, not nice to have, is probably one of the simplest tests you can use in any market. Product market fit sounds like a big VC term, but in reality, it is very human. If your product disappeared tomorrow, would your users actually be upset? And I also love the one sentence test, because if a founder needs 10 minutes and 20 slides to explain the product, sometimes that is already a small warning sign. In crypto, we can get distracted by big token numbers, fancy technology, very exciting narratives, but none of that matters if users do not really need the product. And this becomes even more important during a bear market, because when the hype disappears, the real value becomes much easier to see. And a nice to have product can survive when everyone is making money, but when the market gets cold, people quickly start cutting the things they do not need. I've been through this cycle, and I just watched how my friends, or I don't know, colleagues or acquaintances are just losing their business, and they're not even realizing that they're in the process of losing their business. So I think that simple question, can users live without it? It is actually a very powerful filter for long-term investing, and maybe that is the best antidote to crypto hype. Less looking at the rocket emoji for in QL posts, and more looking at whether someone would genuinely miss the product if it was gone. So yeah. Um, on that note, I'm out of questions, at least for this session. In real life, Alice, I will talk to you with more questions. I hope we can meet each other in Singapore soon during Talking 2049, as we're hosting the flagship event, RWA Summit, soon there.
Happy, yeah, happy to.
And if you have some final thoughts for viewers and listeners, feel free to speak up.
I think so far so good. We've talked most of the points through the interview. Thanks for having me here. Really a pleasure to talk to you.
Thank you. Same here. And you brought a very broad perspective to the conversation. We've covered a lot of ground today for sure, from the future of tokenized collateral and institutional adoption to the role of exchanges as ecosystem builders, and the emergence of autonomous AI-driven finance. Even from my side, what really stands out is that RWA opportunity is ultimately much bigger than simply putting traditional assets on a blockchain, and it's about rebuilding how value, collateral, liquidity, and trust move through the financial system. And as we discussed, making that vision real will require not just the better technology, but stronger distribution and regulatory clarity and sustainable business models and general demand from users and institutions. So, Alice, thank you so much again for being a part of this online interview at RWA Week. And thank you, everyone, watching and joining us live. This was Polly Speaks, and we will see you at the next conversation, shaping the future of real world assets. And see you soon, everyone.